I think there will be positive returns on most assets. The obvious risks are, number one, that I'm wrong about the global economy accelerating. The other way in which we could be wrong, and I think there's quite a bit of concern about this, is that inflation actually picks up. On the positive side, things could get even better. Maybe artificial intelligence starts to play a role in boosting productivity. Who knows? Let's dream.
Die Geldmeisterin. Der Finanzpodcast mit Julia Kistner.
My name is Paul Jackson. I am the Global Head of Asset Allocation Research at Invesco. I guess I've been in the industry for about 38 years, so yes, I've got grey hair and not as sprightly as I used to be.
And to get to the point, how would you describe the capital market 24 in a few sentences? You just said great. What do you mean by this?
Yeah, I think the performance has been very good, especially for more cyclical assets such as equities, high yield, real estate, and some commodities. Gold in particular has had a stellar performance this year. It's for the last 3 years, it's just got stronger and stronger. But largely, it's been a question of cyclical assets being favoured, which suggests to me that there is confidence about the global economy.
And you just summarized it with a song of Led Zeppelin, Celebration Day. Couldn't it be also Stairway to Heaven?
Yes, although I wouldn't be so presumptuous, especially at my age.
But just to get through the points why it's a great year, this year in 2024 and also in 25. Why is it? You said once we could avoid the recession. How come?
Yeah, I think one of the factors this year is that we have avoided recession. We had a lot of inflation a few years ago. Central banks tightened a lot. Yield curves became very inverted, so there was a big concern there would be recession. But we've avoided that, so I think there's some relief in markets. Also, this year, 2024, central banks have started to ease. Mm-hmm. And you've had 60 central banks that have eased policy. So I think that helps the market environment. And markets have been anticipating that lowering of interest rates. So I think those are the main factors. Maybe in the US there's been a little bit of optimism about the victory of Donald Trump as well.
Mm-hmm. And why should we be happy of this election in the United States?
Well, I think if you use the historical context that in previous election years, the performance of US assets has been better in the year after the election than in the year before. Also, when you look at the first year of Fed rate reductions, US assets have performed well when there has not been recession. And I don't think we'll have recession now. So I think those two things put together give some optimism for the future, but also you've got inflation coming down, interest rates coming down, which hopefully gives more growth globally, which I think will help asset markets.
And you also said that this was very interesting that, and it would be very rare that the Fed has started reducing the interest rates so close to the elections. Why Paulson did this? Is it because he fears recession? Or, the situation is not that bad in the United States.
Well, it's funny. No, I think if you look at GDP growth, mm-hmm. it is okay. In the third quarter, you've got GDP growth annualized at around 3%. Unemployment is still pretty low. But if you go back a few months to the beginning of August, we had a piece of data that was published for the labour market, which suggested the labour market was a lot weaker than we had thought, and that brought quite a bit of volatility to financial markets. And so the Fed's the first rate reduction of 50 basis points came in September in the wake of that poor piece of data. The data has kind of improved, I think, since then, but I think that is what frightened the Fed a little bit. But also, inflation has come down a long way, so they don't need to keep interest rates that high any longer. So I think they will continue reducing rates.
And the year after election, you mentioned it's usually the S&P 500 and 600 has risen. Will this be then in 2025 also, you think?
I think it's possible. There are a number of problems, though. Number one, usually in the year before an election, you don't get very good performance. It's just a very mediocre performance, lower than the average year. 2024, we have already had very strong performance of the S&P 500 and the S&P 600, which is the small cap index. So I think expecting another good year of performance in the US is maybe a bit optimistic, especially when valuations are so high. So I'm a little cautious about the US market. I'm more optimistic about markets elsewhere.
So as an investor, you would underweight then the United States and overweight other markets?
Yes, so it's hard to do because the US market has been outperforming.
Yeah.
And so there's a lot of momentum. It's hard to persuade yourself to do that. But honestly, I think that the return potential is a lot stronger in China, for example. And I think that European equities, if we have an accelerating global economy, so we get more economic growth, I think the European market, the composition of European indices is more cyclical, so I think they will be favored versus the US.
And is there any risk that we don't have an accelerating global economy?
Oh, for sure. Just as we've been forecasting recession and it didn't come, and expecting better growth, we may be wrong about that as well. And I think where could the risks come from? Number one, let's look at the new presidency in the US. Imagine that we do get a broad trade war, then I think that is bad for global growth. It's bad for everybody, for the US, for China, for Europe. So I think that is one clear risk. It may be that we still haven't seen the full effects of the monetary tightening over recent years, so we may get some delayed effect there. And also, let's just imagine that inflation, there are concerns about inflation. Let's imagine that inflation goes higher rather than lower, then central banks would ease less, and therefore economies wouldn't perform as well as we're expecting.
But do you really believe that he will put 25% tariffs on Canadian and Mexican products? This would harm also the economy in the United States?
Well, you would imagine so. That's what logic dictates. Yeah. But remember that during his first presidency, we had a real standoff between the US and Canada and Mexico. NAFTA nearly basically collapsed. He did impose tariffs on the European Union and on China. And so I think there is a risk that he does it on Mexico and Canada, but clearly there are already tariffs on China, and he's talking about adding a little bit more. At one stage, he was talking about making those tariffs 60 or 70% on China. So I think it's possible that he's just at the moment talking the talk, and let's hope that the bark is worse than the bite, if we use an analogy from the world of dogs. And maybe he's just using it as a negotiating tactic. But I think he will probably have to impose some tariffs just to make sure that people see that he's serious.
You talked about Trump trade changes to trust trade. What do you mean by this in general?
Well, the Trump trade was this idea that, the election of Donald Trump would be good for US stocks, it's good for the dollar, blah, blah, blah. The trust trade is a reference to Liz Truss, the former Prime Minister of the UK. And what she did with her Chancellor of the Exchequer was to basically announce unfunded tax cuts. And that pushed up gilt yields. The markets revolted, gilt yields went up, sterling collapsed. And what Donald Trump appears to be suggesting, we don't really have any detail, but he appears to be suggesting further tax cuts. And this is at a moment when the US fiscal deficit is 6.5% of GDP, which is enormous given that the economy is growing relatively strongly. So if you get those unfunded tax cuts, you get a widening of the fiscal deficit, there may come a time when the markets revolt and say, no, enough is enough. And treasury yields could go up, and I think the dollar weaken.
But didn't they already get up? So didn't the market already react?
There has been a reaction, and you can see it in the term premium on 10-year treasuries, which was around 0 in early September. It's now gone to around 50 basis points. And I think that there could be a number of reasons why that happened, but I think part of it was the growing confidence that Donald Trump would win and concerns about what his fiscal policy would be. To some extent that is in there, but I think it can always get worse and can get exacerbated.
You mentioned you prefer European stocks if the world economy doesn't slow down, and also Chinese stocks. So you're not afraid of a new trade war then?
Well, I have the view that, yes, a trade war would not be good for the European economy or the Chinese economy, but equally it would not be good for the US economy. So I don't understand why people think, oh, trade war, US stocks should go up and European and Chinese stocks should go down. I think everybody suffers.
Yeah.
And if the United States is fighting against both Europe and China, it's taking on a lot of economic might between the two of them. And it will suffer the consequences because they will retaliate as well.
Is it just the valuation in China and Europe that you prefer them, or are there other reasons?
I think, first of all, I'm a big believer that buying cheap assets is better than buying expensive assets. So, history tells us that if you buy assets when they're cheap, you get pretty good returns. If you buy them when they're expensive, you get poor returns. Just take a look at the long-term history of the US market. So, yes, valuations are very important to me. I think it's the major determinant. The major determinant of returns on my portfolio is the price that I pay for an asset. So yes, the valuations are important, but also I think particularly for Europe, if the global economy is improving, Europe has this greater weighting in cyclical stocks than does the US. And also I think China, I think there's just way too much pessimism about the Chinese economy. And, the data is a lot better than I think people are giving China credit for. It's got an increasing number of technologically advanced industries where it is starting to dominate globally. So it started with solar panels, it dominates that industry. Now it's starting to dominate the electric vehicle market. So they're moving up the value-added chain, and I think on that basis the Chinese economy and the Chinese stock market at these prices should do relatively well.
And do you think we have right now a mispricing at the stock market which is higher than in former days, and why?
Well, yes. First of all, the US market is very expensive. On my calculations, a cyclically adjusted PE ratio of around 45. Historically, on average, it's been a lot lower, closer to maybe 20 than 45. So that is towards the upper end of its historical range. China is towards the lower end of its historical range, that cape, rather than 45 that we see in the US, it's more like 15 in China. So I think there is a big discrepancy. And also you see it when you look at levels of concentration in markets, particularly the US market. We are at an extreme of concentration at the moment in a limited number of stocks.
But this is usually not a good sign for the market, but you are still very bullish on stocks.
Well, no, I'm bullish on some stocks. I'm not bullish on the US market. So if you look at my equity allocation, I'm actually underweight equities within a global model asset allocation. I'm underweight equities, but within that equity allocation, I'm positive on China, I'm positive on Europe, underweight the US, and I'm also actually underweight Japan. because I think the yen will strengthen a lot, which will dampen Japanese equity performance.
And is there also a mismatch at the currency market? Because the dollar, you just showed it, the dollar is very, very high priced right now, and as on the other end is the Japanese yen. So will we see a new equilibrium this year or in 2025?
Well, I think if we got equilibrium, it would mean a massive appreciation of the yen. The yen is currently 40% below where it has been historically on real trade-weighted terms. And the dollar's maybe about 15% above where it has been historically. So the big discrepancy is the yen. I think in 2025, with the Bank of Japan tightening while other central banks ease, I think the yen will appreciate. So I think we will reduce some of that discrepancy, but I don't think we're going to reduce all of it.
Is there anything you would throw out of your portfolio right now? Because everything goes well in 24.
I guess I've done that to some extent. I've reset the model asset allocation a couple of weeks ago, but I think more generally, what are the assets where I would have some concern? And these are assets that have done extremely well. It is US equities, it is large cap, the broad indices like the S&P 500. I would be wary of that because it's done so well. There's the problem of concentration, but also an asset such as gold, which has had another fantastic year, I think based on a lot of speculative activity linked to geopolitics. And high yield, the spreads are extremely tight, so I'm underweight high yield. And if those spreads just keep getting tighter and tighter, then I would imagine that I would reduce that position as well. But those are the assets that I think have done very well and where we have to be a little bit cautious about the outlook for 2025.
And altogether, would you say the opportunities are more than the risks, and what are the risks?
I think overall the returns on assets are likely to be better than zero. I think they'll be good, but not as good as 2024, and they're not as good as I was expecting a year ago. But I think there will be positive returns on most assets. The obvious risks are, number one, that I'm wrong about the global economy accelerating, and that if we do get a slowdown or indeed a recession, then that's an environment in which you would get better returns on defensive assets. The other way in which we could be wrong, and I think there's quite a bit of concern about this, is that inflation actually picks up, and a rise in inflation wouldn't be good for bonds and probably wouldn't be good for equities either, so that's a clear risk. On the positive side, things could get even better, and we may get even more growth than I'm suggesting, with maybe no more inflation, and maybe artificial intelligence starts to play a role in boosting productivity. Who knows? Let's dream. And if you get more growth and less inflation, that's a great environment for particularly for cyclical assets. So I would be going for cyclical equities, non-US equities. I'd be going for things like industrial metals, high yield, which the spreads are very tight, but under that scenario, they could get tighter. Anything basically that's got cyclicality to it.
And to get to the sectors, what about the banks? They really performed well because of the changes of interest rates and the big spreads. Will they perform in 25 also that well, or is the time gone now?
No, I think they will, and my observation is that particularly when you look at US and UK banks, because there's something very particular about the Anglo-Saxon banking system where they have this big mismatch between assets and liabilities. So they take money in on a short-term basis and lend it out long. So they're really playing the yield curve much more than continental European banks. So when the yield curve is inverted, it's really bad for the banks. When the yield curve steepens, banks tend to outperform. And I think yield curves will continue to steepen as central banks reduce their rates. So I think that's probably still going to be a good environment for banks.
Does that make me crazy?
I seem to remember that you come up with crazy theories every year. What are they for 2025?
Well, I wish I knew. To be honest with you, I don't start thinking about this until after Christmas, but no doubt, it will involve things like, who's going to be the first member of Donald Trump's cabinet to disappear? How long will the relationship between Donald Trump and Elon Musk last? But I usually try to be out of consensus with the ideas, so sometimes it works very well. Other times it doesn't. And if you look at, what is the consensus at the moment, if you think about the way the markets are behaving, it's, everything is fantastic. So I'll be maybe looking for some more bearish ideas.
And are you happy that the finance minister in the United States is a hedge fund manager and specialized in bonds and treasuries?
To be seen. I think the market reaction has been positive. Bond yields have come down. It's almost as though, oh, thank goodness for that, we're going to have an adult in the room that is going to control some of the worst instincts of Donald Trump and some of the people around him. But I think it is to be seen, number one, whether he can survive, whether he can handle that sort of environment. And number two, what will his influence really be? Will he be able to outvote and convince Donald Trump to do things other than what Donald Trump's instincts tell him he should do? So I think it's to be seen what Scott Bessent's instincts are telling him to do, and whether, if they're in competition with Donald Trump, who wins that. And if he has got very different instincts to Donald Trump, will he survive?
Mm-hmm. And as you come from the UK, what do you prefer, equities from the EU or from the United Kingdom?
Both of them I'm overweight within the model asset allocation. I think if we do have a very strong global economy, then the UK gets some benefit because of the exposure to raw materials through energy stocks and through metals and mining stocks, which have got nothing to do with the UK economy, but they just happen to be quoted in the UK. Otherwise, I like both. UK banks, probably I'd prefer to European banks because of that yield curve argument, but I'm overweight both of them.
Okay, then I say very much thank you for taking your time, Paul, and I wish you a good flight back to the United Kingdom.
Thank you very much. Always a pleasure.
Alles Gesagte ist nur die persönliche Meinung von Julia Kistner und daher keine Anlageempfehlung und keine Rechts- und Steuerberatung. Für Verluste, die aufgrund von getroffenen Aussagen entstehen, übernimmt die Autorin Julia Kistner keine Haftung.